I've spent nearly a decade of my life trading energy derivatives, and today I want to tell you the story of my biggest win, which coincidentally was also my biggest mistake. So, I was trading Brent crude at the time and had taken a long position. However, the trade was not going in my favor and I had hit my stop loss. Ideally, I should have booked the loss and closed out my position, but my emotions were running high and got better of me. I did not close the position despite the stop loss trigger. I was not thinking clearly and was just hoping for the price to turn and start moving in my direction. Coincidentally, there was a major political event in the Middle East that catapulted the oil prices to sky high, and I made a massive profit from the trade. I made more from that single trade than what I normally made in the whole quarter. I clearly made a bad decision, but it turned out to be great. The right thing to do was to take the loss and close out the position, as I could have never predicted the event. That is why it's so important to focus on the process more than the outcome. You see, the way we get better at anything is by going through repeated cycles of action and feedback loop. You take an action, you get an outcome. You take feedback from the outcome and adjust your actions to gain a more desirable outcome in the next cycle. And then you repeat this process to get better with each subsequent cycle. Take learning how to ride a bicycle, for example. You probably started off with training wheels or with the support of your parents to help you keep your balance. You definitely would have fallen a couple of times, and over time, with practice, you got better and no longer required the support to ride free. However, the same process of learning breaks down when you apply it to markets. Unlike riding a bicycle where the outcome is fully dependent on your actions, in markets the linkage between your action and outcome, it is messy. Over short time frames, markets are often driven by noise, random events, headlines, and unpredictable external shocks. These can heavily distort outcomes, making it difficult to judge the quality of a decision based purely on what followed. While riding a bicycle, if you don't keep pedaling, you're bound to fall. There's a very strong and direct link between your actions and the outcomes. The information produced from your action is highly reliable and thus can be used as a feedback in the next cycle to keep getting better. However, in markets, a good decision can lead to a bad outcome, and a bad decision can lead to a good outcome in the short run. In markets, the link between your actions and the outcomes is not fully robust. You are in full control of the investment decisions you make. However, the outcome you get from the market depends a lot on the collective impact of millions of other people making similar uncoordinated decisions. I clearly made a bad decision by not closing out my position after hitting my stop loss, but it produced amazing outcome for me. Thus, had I kept evaluating my skill based on the profit and loss statement alone, it would have been very hard for me to become a better trader, since I would have ended up making spurious connections between bad decisions that yielded good outcomes and good decisions that yielded bad outcomes. I recently met a client who was telling me his story of how he increased his net worth from about 10 crore to 50 crore in just 5 years. He started investing in equities and right before COVID he decided to leave his job and become a real estate broker. He arranged the initial capital by selling off his home and invested in multiple attractive real estate projects which were under construction using very high amounts of leverage. He took more debt than his capacity. However, since the market was doing fine, he had no problem staying afloat until the COVID hit and his income suddenly dropped to zero, and he still had to service the massive amounts of debt he had piled up. Real estate assets by their very nature are highly illiquid, and especially so during the market stress. He desperately needed to sell off one of his properties or he risked going under. Luckily, he did manage to close the deal on one of his properties in time and keep his head above the water till things started looking bright again. Over time, his investments appreciated well in value and his brokerage business also took off. Things turned out well for him. In hindsight, while telling his story, I got the sense that he grossly underestimated how much trouble he was in. He seemed proud of the risk he took and even advised others to use similar tactics to get deeper into real estate. He clearly made a bad decision. Had he not managed to sell off his property in time, things could have ended up very differently for him. That is why I always stress the importance of focusing on the process of decision making instead of the outcome. Whether you are evaluating your own investment decisions or evaluating someone else, you should always look at the process through which the decisions are made instead of solely relying on the outcomes to tell the whole story. Were you disciplined while making these decisions? Were the decisions consistent with the objective of the investment policy statement? Were the risks limited? Were the risk limits respected? Outcomes are apparent. You cannot unsee them. However, one needs to open their eyes and look for the process that led to the outcome. Because oftentimes bad decisions can lead to good outcomes and good decisions can lead to bad outcomes.